Welcome to the HC Commodities podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. Today, we're rejoined by Colin Bryce, founding partner of the energy consultancy Energex Partners, with a long and illustrious career in commodity trading behind him, including being co-head of Morgan Stanley's commodities division. Colin, alongside Adi Imsirovic, have written The Rivers of Money, a social and economic history of modern oil trading. And Colin joins us to talk about this unique and fabulous book. As always, you can really support the show by leaving us a positive review on the platform you're listening on. And as always, I hope you enjoyed the episode. Well, Colin, welcome back to the show.
Thank you, Paul. It's been a year or two, I think. Number 8 or number 9 on your list of podcasts, I think, something like that.
Yeah, an early 2 episodes, which we did on what it takes to build a trading platform and what it takes to be a trader,
right,
which has certainly stood the test of time, and kind of going to circle back to that at the end of this discussion. But we are here to celebrate, to enjoy and discuss your book, The Rivers of Money, a social and economic history of modern oil trading, written by yourself and Adi Imsirovic, and it's a fabulous book. I got my copy, came over the weekend. I read through it yesterday, and and I actually want to read chapters again. And it is exactly as you described, right? It's a social and economic history of modern oil trading, and to my mind is a story that actually hasn't been told. We've been told about certain personalities, Mark Rich and so forth, and we've been told about the commodity industry more broadly, often through the lens of scandal and other history. But this is actually how oil trading took its shape, the characters involved in it, the social aspects of that, the economic aspects of that, the geopolitical aspects of that. And, for me, is a very important book, not just enjoyable, but one that tells a story, as I said, that hasn't been told. A couple of quotes before we get started, just to set the tone. So, Texas Monthly, 1984, quoted in the book, "Traders are financial speculators, con artists, impoverished aristocrats, former tennis pros, ambitious young college and B-school grads looking to make their fortune as fast as they can." Which I think is a fabulous quote, and certainly some of the characters we know fit within that.
All sorts of flies, Paul, were drawn to the light over the years, I think.
And part of the book is about actually sort of this idea of some of the unique personalities and some of the unique skill sets that made a good oil trader back in the day. And you and I have a live debate about how technology is changing that. One other quote, Mark Rich didn't judge deals, he judged people who brought them to him. And you say that's a dominance of qualitative over quantitative, which I think is, again, some of the bits that can get missed in this story. But I guess the book starts in the very early days, way back in the turn of the last century. But really, I guess there's a few key narratives here. One is how the London market started and how the London market came to dominate oil trading. You talk about the rise of other hubs, particularly obviously Wall Street, and their different path compared to London, how Singapore came about, how the trading houses arose and where the talent came from to fill those, and then bring it right up to the present day with paper trading and algo trading and so forth. But let's spend a good bit of time talking about the London market. So if you could just sort of set the scene for us. In the 70s, we had obviously the rise of OPEC, oil shocks, and sort of suddenly the world looked a lot less dependable than it did in terms of supply. So can you sort of pick that up and tell us how London came to dominate oil trading, particularly, I guess, outside of the US?
Yeah, sure thing, Paul. We did at the beginning of the book focus a little bit on the geopolitics that kind of set the scene for this whole development of a market in a traded market in oil. We weren't trying to compete in any way with some of the great geopolitical books out there, the Dan Yergin's book and the Para book. But we did a little bit on that to set the scene, because of course, really it was the demise of the hegemony of the majors that in the sort of late 1960s, early 1970s, and the rise of the hegemony of the producing nations that created the situation where some oil became freely available to be traded and moved on an open market. And, some folks got together, big oil company people, formed little companies and, started to trade that little bit of free oil. And, that was the way in which the business really kind of started in the early 70s. At the same time, there was a little bit of a business going on in oil products, focused around mainly Rotterdam. Also something going on in New York Harbour. And there were little companies there who were dealing in the sort of offcuts that the majors, didn't need, or, helping balance supply in different sort of circumstances. And that so-called Rotterdam spot market was very important in the early days, and actually hasn't really been memorialized particularly. And we wanted in the early stages of the book to find out a little bit more about that. Happily, some folks who were involved at that stage in the early 70s are still with us, and we were able to get views of and reminiscences from the participants, and memorialize stories and circumstances that otherwise are going to be shortly lost. So, you had this free oil from the majors, from the producers, as the hegemony of the majors declined. You had this little bit of sort of balancing oil product business in Rotterdam and New York Harbour, and that was really where Mark Rich, for example, and Philip Brothers in the early days started to develop their businesses. That continued throughout the 70s. And then there was an event at the end of the 70s that was pretty important in the creation of the market. And that was the Iranian Revolution, because that created a situation where there was a perceived shortage, and oil prices went up very dramatically. And a number of countries who had negotiated term contracts with off-takers decided that they would rather reduce the amount of oil they were offering to these term customers, abrogate contracts effectively, and place that oil on the higher priced spot market. And, those who were thinking they were going to be short, such as, Japanese companies, for example, who were very dependent on the import of oil, started a little bit of a spiral upwards in prices. And I think at that stage, a lot of folks decided that actually having term contracts was not a particularly secure avenue of supply. They'd be better off, buying a whole series of different spot contracts across the board. So the spot market, if you like, was founded. And this was before really the North Sea got going in an important sense, because the next thing that happened was that the way in which particularly the UK government decided to tax the oil that they had found in the North Sea, and also given the way that they chose to address security of supply, caused there to be a surplus. And the book was in quite some detail to
this is so it's done over a few chapters, and I can't sort of overemphasize this. The nature of the book is also talking, the social pieces, talking to people who were there at the time and how they perceived all this. But yeah, you had this, the spot revolution that comes from the 1979, the revolution. You kind of had this confluence of the petroleum revenue tax versus corporation tax. So there's sort of weird tax incentive. And then the creation of which I know you and I have talked about it in the past, that I've never really done my homework on it, but the British National Oil Corporation, which is a creature of the 70s, it seems very much, that had this sort of bizarre unintended consequences. Can you just give us a few words on that, and how that ultimately led to this oversupply and the people that I guess were involved in its creation and leading it.
Sure. Well, BNOC was a creation of the government. At the time in the UK, there was a socialist left-wing government, and they were very keen on state participation in what they considered to be a wonderful resource that they had come across in the North Sea. And so they supposedly wanted to ensure for the country security of supply, but they also wanted to get a taxation revenue back from the companies that were involved, without discouraging the companies to go and explore there. And the way in which they did that, or the way in which they did these two things, taxation and security of supply, which we've talked about in detail in the book, created a situation where BNOC became effectively a distressed seller in a falling market. And that falling market was the way in which things were between 1980 and sort of 1986. It culminated in the net back pricing revolution that occurred at the end of that period. And in the falling market, they were in a position where they had all this oil that the state had decided that they wanted to participate in, and no real secure outlets for it at the prices they were having to buy it at. And so this huge surplus appeared, and that really was the first big lump of available tradable oil anywhere in the world. And some very smart people, and companies driven, I think, clearly by self-interest, managed to find ways of trading that oil for, corporate gain and personal gain, in that it created a market for people who could do this stuff, and a well-paid market. So you got a bunch of folks developing trading businesses based in London, because that was where the North Sea oil was. They had a regime, that was favourable to financial services at the time, and a stable legal system. And the Brent market arose. It was the Brent Ninian 40s market initially, and we talk in the book about how the idea to create that market occurred to a group of people who used to lunch in a small restaurant in central Mayfair.
This is the Guinea.
No, this was another place in Dover Street that was a very popular lunch place, and where they kept a couple of telephones. Of course, there were no mobile phones at that time. They kept a couple of telephone lines open so that the folks from the oil trading fraternity who were lunching there could do business without having to return to the office. And actually, Chez Gerard, which was the name of that particular brasserie, was not the only such office, if you like to call it that, which traders were able to spend lunchtime and a lot more in Mayfair. And, as we say in the book, you couldn't go far in Mayfair in these days without coming across a gossiping oil trader. Mm. And it was there that the Brent Ninian 40s market was created, and it morphed very quickly into the 15-day Brent market. And Shell got behind it, BP got behind it, the big guys. Exxon didn't, not really trading orientated, but enough behind it to create this traded and tradable market. And over the course of, I would say, the first 4 or 5 years of the 15-day Brent market, it attracted all sorts of rogues, as well as the major oil companies and some new trading companies. And over that period, there was there were times where people had to be disciplined, and some were barred from participating in the market. And Shell particularly became the sort of the regulator, if you like, in inverted commas, and guaranteed the efficacy of the business. And they did enough there to survive, 4 or 5 years of people squeezing the market, and odd sorts of characters coming in and participating that shouldn't have been there.
The energy and resources sector is experiencing unprecedented change. To help navigate this change and capture its opportunities, HC Group launched Enco Insights, a global advisory network dedicated to the sector, providing senior advisors and subject matter experts to investment and infrastructure funds, law firms, and corporates. Enco Insights leverages HC Group's 20 years of connections in energy and commodities to give clients the expertise they need when the stakes are high and insight matters. Learn more at encoinsights.com.
It's fascinating because in some ways it really marks the contrast between how oil trading developed in Wall Street versus London, and London essentially being this, the 15-day Brent contract was essentially a product of necessity, some sort of way of managing quite, changing, obviously North Sea oil coming on, but also lots of volatility and changing, no surprise at this time, BP in particular had lost its security of supply and so forth. And it was a function of this spinning you talk about in the books, trying to optimize tax and so forth. And also kind of a nature of, and this is the social bit of the book, is London is all about, or the London trader it's all about being clubbable, as you talk about, right? Lots of that business isn't done in an office. A lot of that business is done on handshakes, on the individual brilliance of trying to chase down deals and manage deals and so forth. And you talk about in the book about the daily life of a trader and, walking around with a briefcase that was often empty. It is in stark contrast to Wall Street, where really that market formed around NYMEX contracts, which led to a very different outcome and types of participants. Can you sort of, I guess, contrast those two and then talk about how Wall Street got started?
Sure. I mean, NYMEX was the Wild West in a different way, wasn't it? The folks that went and made their fortunes, on the floor of NYMEX have been characterised in many different books as cheeseburger eating kind of, Brooklyn thug types and their friends. And all sorts of folks got onto the floor at Wall Street, provided they could shout loudly enough and could, bear the heat and the jostle, and then, drink enough market to be part of the crowd. And we kind of try to reflect that in the book. And NYMEX became very quickly the place where the price of oil was set globally. Brent and 15-day Brent in the North Sea in London, may have been the big over-the-counter paper market, but it followed NYMEX. NYMEX opened and Brent followed. And what Michael Marks created in these early days on the NYMEX exchange was, seminally important for the development of the market. But it was different from the way in which the over-the-counter market in London developed. However, they were complementary. There's no question about that. You had NYMEX, which featured a landlocked American crude oil, WTI, and some product contracts. And you had, the over-the-counter Brent market, which featured a North Sea internationally traded grade. And, it enabled arbitrage between the two, and it created an environment where, people could see prices more visibly than perhaps on some of the over-the-counter business that had gone before NYMEX. So very important. The Wall Street refiners, if you like to call them that, Wall Street warriors, as we call them in the book, came into the market in the sort of 1984-5 period. Morgan Stanley started the trend, very quickly followed by Goldman Sachs and then Drexel, Burnham Lambert and Bear Stearns. And they were attracted by the growth of NYMEX, really, whereby they could use futures market liquidity to offer the same sorts of risk management services to their clients that they were offering in metals and agriculture and currencies where there were existing futures markets. And so this NYMEX growth suited them really well. And not only that, they saw that the Brent market in London was also quite liquid, albeit in a different way, and they wanted to be able to participate there because then they could use that market in order to hedge themselves, so they were able to help clients internationally. So they hired some international folks, and they got going in the Brent market in the sort of 85, 86 period. And something happened there that was very important for them, and that was that Saudi Arabia got tired of being the swing producer and decided that they were going to abandon that idea, produce everything they could, and sell it on what was called a net back basis. Basically, they'd sell to the refiner, and whatever the refiner was able to churn out was what the value of the oil was, and a little premium was put on it, and the refiner got a guaranteed profit, and that then quite naturally caused everybody in the refining business to get as much oil as they possibly could, because they had a guaranteed margin. And so the market flooded, and the price came down very significantly, and bottomed out in, I think it was 1986 at maybe $9 or something like that, having been at mid-30s a few months earlier. And Saudi were determined to give that message to the other OPEC members who had been stealing their share of production and cheating on quotas over the years. But that situation of prices swinging around was manna from heaven for Wall Street, because people who were dependent on having a stable price at the market interface found that there was a tremendous amount of instability and volatility there, and they needed to manage that. And Wall Street came in with their various techniques developed in metals and agriculture markets, and they helped manage that risk for their clients.
Became huge, and it's became huge market makers. Some of those names, Steve Semlitz and Steve Hendel, and people who are still leading groups today, sort of kicked all that off. And the other thing that happened as well, you mentioned in the book, is at that period you could make a lot of money. So the money goes from sort of hundreds of thousands to millions. When we get to the present day trading houses, you talk about it now, now in the billions, and a billion's not that much. But, at that time, you can make a lot of money if you were sort of an independent trader, which was very risky. You can make a lot of money as a broker. It was the advent of actually the US market being dominated by Goldman Sachs and Morgan Stanley that kind of introduced the idea of, pretty aggressive bonuses as well, that then suddenly those, BP and Shell and the majors had to compete with us. I mean, it was a huge influx of money and opportunity on an individual level.
Yeah, and the offer of a job with a Wall Street refiner was what everybody wanted in these days. Of course, that's what everybody wanted, and they paid significant bonuses, but they brought a seriousness of purpose to the market. The market kind of stopped going to lunch when Wall Street arrived. They started to eat sandwiches at the desk, because that's what Wall Street did. And they were on the business the whole time. The business became faster, more techniques and different strategies were introduced by Wall Street, and so there was a seriousness of purpose developed at that point. I well remember I was employed by Wall Street, by Morgan Stanley early on. I well remember more than one comment coming my way, which was, what is the black box that you guys have on Wall Street? And people really thought we had some kind of a black box that, was doing something that they couldn't do. In fact, there was nothing like that at all. It was very simply, hard work, seriousness of purpose, looking for relationships, understanding these new techniques, putting it all together in a way that the Sir Lunchalots, if you like, of the 5 years prior hadn't, wanted to do. Not to say they weren't able to do that. In fact, they were, most of them, very able to do that, because, although there was that veneer of these sort of, what did you call them earlier on, con artists, impoverished aristocrats, former tennis pros, there was a veneer of that. But it's a little bit of a caricature. And broadly, the people who were involved in the business were highly intelligent and well able to eventually change the way in which they worked. And of course, BP, Shell, Vitol, Trafigura, Glencore, Total, all these non-Wall Street companies, very quickly got up to speed and were doing the same as Wall Street. And many of them have outlived Wall Street in that they haven't been, adversely regulated out of the business in the way that Wall Street was in the post-financial crisis period. But it was a very interesting time. It was a fun time. There was discovery taking place. The market was developing, it was being created, and you had that sense that you were doing something that was going to change. You weren't sitting, going to do the same thing every day for the rest of your life. Buy, sell, mine, yours, up, down. It was more than that. It was a developing business, and
it's quite a different role as well. And I guess we'll come on to this at the end. Yeah, how the skills and the roles have changed. And that evolution was quite fast, right? Since the 70s clubbable to obviously Wall Street coming in. Then you had gas and power. It's amazing how fast it has moved. We're talking about a sector that's sort of 45 years old in some senses, and just the changes. The book talks a lot about the individuals who launched BP. I mean, these are, as you say, very serious, very intelligent folk who crafted and created the modern integrated trading platform around assets. And you talk in the book about sort of that interplay. And the same goes for Shell. The book talks about how the rise of Singapore, Ian Taylor, of Vitol fame as a young Shell trader around their refinery out there, and the rise of China. There's lots of stories and seminal moments to pick out, but I guess one that I guess I knew the story, but it's kind of fascinating to get the insiders. Can you tell us about Mark Crandall and his momentous role in this sector, reverting, coming back to the private trading houses, and obviously what Mark Rich started doing out of the New York Harbour and so forth?
So Mark Crandall was an ex-colleague of mine, actually. When I joined Morgan Stanley, we were colleagues, and he recruited me. One of the three people who recruited me into Morgan Stanley, and he had been the youngest ever managing director of that company, and was the son of the famously crusty Bob Crandall, who was the CEO of American Airlines. And Mark was an ambitious fellow, and not long after I joined, he resigned from Morgan Stanley, in his own words, because he wanted to do something more fun and more interesting, and that was to join Mark Rich, which he did. And he was with Mark Rich for a number of years until there was an issue in that company. Mark being banned from the US. He was going through a divorce, and things were not great in the company. And some of the young Turks, if you like Mark Crandall and Claude Dauphin and Graham Sharp and various people, were keen to find out how they could take over the business. What was the succession plan there? And Mark Rich resisted the whole thing. So there was a bit of a revolution took place, and we describe how that actually happened.
Although Claude Dauphin was, there's a bit of, it's sort of not a straight line, right? It's described Claude Dauphin was actually just going to return for personal reasons to his family business, but that was taken as sort of part of a mass resignation that kind of precipitated all the events that follow.
Yeah, I mean, and as Mark said to me, he started the flame, but the gasoline was already on the floor. And they created this company called Trafigura. And in fact, a deal that they had thought they had signed with Mark Rich, which was then sidelined, came back some months later to be the deal that created Glencore. So both arose at the same sort of time in the very early 1990s. And, they were two of the many offspring, if you like, of Mark Rich. There are rumours of many others he was involved in. And he had a seminal role in the development of oil markets. His resignation from Fibro in the early 1970s and his creation of a trading company there, created a model which was then followed and developed and, fine-tuned. And he was very important in the way that trading developed then, and remained important in the sort of late 80s, early 90s, in spawning some of the companies, who today are the sort of biggest, I suppose, best remunerated, least well known, sort of most influential companies in the globe. And
well, yeah, you say like in the top 6 revenue generating companies in Switzerland are commodity traders.
Yeah, and so it's not just vacuous hyperbole to characterize them in that way, because they are. It's it's remarkable that these companies exist behind the curtain almost.
Mm. He didn't. Mark didn't share the origin of the name Trafigura, did he?
No, actually, I should ask him.
Yeah, if you could, because my thesis is it's la otra figura, which means the other person.
Yeah.
But I think all listeners would like to know the answer to that.
Yeah, I mean, it wasn't just Mark. I mean, Claude Dauphin had a major role in setting the thing up, as did Rick Turkheim and Graham Sharp. But, Mark, I think Crandall was the lead negotiator with Mark Rich. He was the guy that sat down with a bottle of Black Label and negotiated the deal that Mark Rich reneged on, that caused these other guys to go and found Trafigura. And that deal that he reneged on re-emerged as
Glencore, yeah.
Hello, I'm David Hunt, founder and managing director at Hyperion Search. Founded over a decade ago, Hyperion Search has helped organisations from major utilities to startups recruit their leadership teams and key individual contributors to accelerate both their growth and the energy transition. Our three main verticals are renewable power, energy storage, and e-mobility. The energy transition and the talent that delivers it has been our passion since day one. To find out more, visit hyperionsearch.com or listen to my Leaders in Cleantech podcast, available on all platforms.
Mark himself says, these trading houses, so you've kind of got the Wall Street refiners, who are driving transparency, driving market optimization, a lot of innovations. There's a fascinating vignette in the book about your role in launching ICE and how that came about. You've got the London-based market, the sort of the integrated majors, and then you've got these trading houses that, as Mark Rich says, are doing hard things in hard places. And the shot in the arm to all these organizations, particularly Glencore and Trafigura, is obviously then the opening up of Russia, which you yourself at Morgan Stanley had some hair-raising stories that I think it was in Owen Johnson's book, 40 Classic Crude Oil Trades, described one of those. That was, again, I just think about the role of a trader then. It was getting on a plane, going to risky places, meeting some tough people, a lot of complex negotiation. I mean, it was sort of that perfect blend of very smart but clubbable people who could go and open up these markets. Can you just give us some sense of those times and the people that did that?
Yeah, it was, Russia, I think I would characterize as a disappointing diversion because it's all amounted to very little, actually. But, in the sort of early 1990s, there was a fairly sort of stagnant oil market. Nothing much was happening. And people were casting around, looking for ways to make money. And some of them went down the sort of gas and power route. These markets had deregulated or were deregulating in the US and elsewhere at that time. And, that most recently actually has become a tremendous source of revenue for trading companies. Anyway, that, some went that way and others decided to step on a plane and get themselves out to Russia and see what, might be done there as, Soviet Russia broke up. And again, much like in the early days, you had people of all sorts of colours. You had the members of the underbelly of the industry, and you had the good guys. And we all travelled out to Sheremetyevo Airport on a Monday and met again on a Friday night and came back on the BA flight and stood in the gantry, the galley, and drank beer and exchanged stories. And some folks made a lot of money there. I think primarily, I suppose on the edge of legality, I would call it, to be kind. Taking very cheaply priced domestic oil and finding a way to export it by sorting out what they needed to sort out with the various customs authorities and pipeline companies and whoever, in whichever way they needed to sort it, they did it. And then they sold the oil in the open market internationally for a huge amount of money. It was difficult to do business above the board, if you like, eventually there. And it became a very disappointing, I think, era for people who tried to make something work in Russia. It never really did for on a long term or a strategic basis, and I think still isn't.
Well, I think it's subsequently gotten worse, right?
Yeah.
Now for McDonald's, Starbucks, and everyone else. So again, there's so I can't tell you how much I enjoy the book, and there's so many stories we haven't touched on or mentioned. The book sort of ends up, a lot of this is, we're just going back to sort of, discussions we've had, is kind of, you quote, well, you say in the book, what makes a good trader is intensity, being social, emotional intelligence, gregarious, this sort of clubbable nature, but kind of with a deep, raw, IQ sat behind it. Then you at the end of the book, you talk about how quickly, technology is changing it. And you quote me as saying, the difference due to human perspicacity and brilliance has gone away. And I guess this is sort of an argument that comes from a conversation that we had around, I feel like the role of a trader has changed dramatically, right? It's much more sort of short term. It's much more sort of technical. I think that's only increasing with the advent of AI. I do feel, however, very much where the skills that made someone brilliant back in 1982, they're just more now what we would probably characterize as an originator, focused on longer term deals and stuff. So my view is that the precise, it depends on how you define a trader, but a lot of sort of what a trader was doing back in the day has changed as a result of technology, transparency, regulation. But some of these things stay the same, right? I think the person that is able to go out there and sniff a deal, source a deal, invest in it, structure it, bring the parties together, still requires this kind of really unique blend of skills that is hard to define in some ways. I just, it'd be great to get your sort of take on, those last couple of chapters.
Yeah, I think it's become a team game, really, hasn't it? The trader is an originator, he's a structurer, he's an analyst, he's a data scientist, he's all of these different things. It's become much more of a technological construct, I suppose, as well, as opposed to a social construct. Having said that, there are two very clear, distinct, quite different arms to what we might call oil trading these days. There's the business of the physical merchants, if you like, sourcing, distributing, selling, exchanging, using optionality, mining the indifference of others and finding a margin and moving physical material around the world. And that business is dominated by Vitol, Trafigura, Mercuria, BP, some of these well-known, long-standing trading companies. And that business still needs the clubbable individual. Yeah. There's a lot of personality involved there. Then there's the other end, or the other side, I suppose, of the trading business these days, which is the really kind of data-driven, financial markets, fast, hedge fund asset manager type of business. So the sort of business that the Millenniums and the Citadels and people at Jane Street and many, many others are involved with, primarily paper businesses, or financial, shall we call it, businesses, operated in kind of cathedral quiet trading rooms, in an anonymous and kind of emotionless way, behind the screens and data mined, and very different to the gregarious, outgoing sort of personality driven, in many ways, physical trading. But that particular arm of the business has become ever more important and dominates, arguably, the setting of price these days. And it's utilizing data and technology to the maximum extent it possibly can. Now, whether AI and, technologically based quantitative trading can succeed, without understanding the importance of, a change in tone of voice, a shrug, a shifting of gaze, the human things that traders do and the signals that they give out that, other traders with their acute antennae can interpret and work with. Whether they can replace that aspect or not, I think, is an open question.
Yeah. Well, I think it depends how much decision remains in the hands of humans, in some ways, right? And again, I think this is lens to the short term. I think one of the things you talk in the book, a thread, is obviously controlling assets. How do you get, trading is about an informational edge. How do you get that informational edge? In the 2000s, we saw the trading houses back into assets, right, and build out sort of almost mini majors to achieve that. And you can imagine that as more and more public data gets scraped to inform decisions, having private data is going to be important. But yes, I just think it's the tenor, it's the longer term calls, the longer term structured deals where these skill sets are still needed. And one thing that does strike you is kind of the world is a lot healthier today, right? I mean, I think if you go back, like hopefully these traders will be around a lot longer compared to what was the demands of being a clubbable trader in the late 70s and all the rest of it, right? I mean, it's quite I find it fascinating.
Yeah, no, it was hard going work often in these days, but great fun. And my sense is that there's not the same fun involved these days, and there's not the same development of intense interest in creating something and what's going to be new and what's around the corner and what we can do next. I think it's not there. That the market has matured to an extent that it has become somewhat stable in terms of its further development, and it's just not as interesting for people. But that's business, that's life, that's the way things happen. And we were very lucky. I was very lucky, and people of my era were very lucky to be involved at the stage we were involved, because as the title of my chapter in Adi Imsirovic's last book said, we were helpful in creating exceptionalism, and it was fun.
Yeah,
and it was socially useful, actually.
Well, that's I think that's the importance of the book. Firstly, it is what markets are meant to do, right? You essentially, yes, 30 years ago, 40 years ago, the place you wanted to be in Goldman Sachs was in the commodities group, and obviously we had Lloyd Blank. We had many CEOs have come up through that route, right? Because that's where the best and the brightest went. Now the market is become very efficient. It's doing what it's meant to do, and I think the book's important in, firstly, understanding the vagaries, the sort of the twists and turns, the sort of serendipity of how the markets ended up like they were. Also, kind of the standing on the shoulders of giants bit, the sort of the great names that we should know but probably don't, as a nature of the commodity trading being quite secretive, right? So I think that's, the book really sheds light on that. And so the importance of knowing why we are here today. And yeah, who's to say, right? I mean, I think at the moment, the best and brightest in Wall Street are trying to get into crypto or whatever it might be, other slices. But, I think the commodity markets, and I always say this, have been a net of force for good in actually making sure that the spice flows, that prices are manageable, that events like, what happened with Russia's invasion of Ukraine don't lead to global catastrophes in terms of starvation or the lights going out. And it's a classic example of actually the commodity markets were made during a period of shrinking government intervention, a belief in free markets. And there's somewhat of a danger there that, we're seeing the reverse of that, and it could disrupt what is a very efficient way of spreading the world's commodities around at the lowest price possible.
Yeah, I mean, I think that, my view, and I think it's the way the book reads, suggests that this whole thing has been socially useful exercise across the board over these years in all the ways it's developed. I think there's a reasonable question that can be asked about whether the magnitude of the reward that has particularly recently been accruing to the traders is reflective of the value they add in certain sectors. I think certain companies are creating billionaires of people just because they happen to be there. And, one wonders whether that's justifiable in the context of what these companies do and the good the utility they create in their business. But it's been a business which I think very, very clearly overall has been beneficial. And what we've tried to do is take the small stories, and the people and the places and the performative locations and how they operated and where they operated and in what way they operated across all these different developments at different times in the last 50 years and try to paint a picture around about that, string it together, and make an interesting, informative, hopefully in parts quite amusing book that people are going to enjoy reading. It was, I think, we set out to write a semi-academic book. I think probably at the end, semi is the more operative, which is fine. It's probably not really until the epilogue at the end that we get into the sort of more academic piece. Much of the rest of it is social history and stories and fun and reflecting how this all took place. So hopefully people will enjoy it.
Yeah. Well, I think it's fascinating. Just to touch on one thing you said there, you do talk about in the book about some of the challenges that might face these trading houses in Switzerland, and obviously the bind that Switzerland's in, given these are now dominating companies. I think that in itself is more of a gas and power story, but is certainly, I think that will be in terms of, I guess, how those markets are constructed and the money that has been made. But I think that is certainly one to watch and one we've discussed. But to your point, I think this is a book that is unique in terms of actually talking about the characters and the stories, and I thoroughly recommend it to people. And we're certainly going to be buying some more copies for our office as well. So congratulations to you and Adi.
Yeah, no, thank you. And it's a true joint effort. I did most of the social bit and Adi did most of the economic bit, and then we combined to do the beginning and the end together, and it's worked out very well, at least in our view. So I do hope people have a chuckle reading it, enjoy it, learn something from it. And it's been a task I wanted to do, to memorialise this business in the way that it's not been memorialised, and to do that before it's too late. So I'm glad we've got it into the canon. I think it sits there in its own, different from other books in the canon, and hopefully will be popular.
Yeah, well, The Rivers of Money, A Social and Economic History of Modern Oil Trading by Adi Imsirovic and Colin Bryce, published by Palgrave Macmillan, available on Amazon and hopefully all good bookstores soon. And Colin, as always, a real pleasure and delight to have you on, and can't recommend the book enough.
Thank you, Paul. That's very kind.
Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.